Hey everyone, welcome back. Today we're diving into the future of commercial real estate, specifically 2025. We've got a really interesting mix of sources this time. A forward-looking report from Deloitte, some U.S. city-focused pieces from Narada and Real Wealth, and a bond market analysis from ING Think. Should give us a pretty well-rounded view of what's to come.
It's fascinating how these sources all connect, you know? You've got Deloitte looking at the global picture while Narada and Real Wealth bring it down to street level, and then ING think they're watching the money, which always tells a story.
For sure, money talks. So let's start broad then. Deloitte seems cautiously optimistic about 2025. They're predicting slower growth, obviously, with borrowing costs being what they are these days, but they don't see a recession as inevitable. And inflation, well, it might simmer down a bit.
The key word there is might. Deloitte's economists are actually forecasting interest rate cuts. That'd be welcome news, right? But here's the catch. They're also saying we're in a higher for longer environment. Think back a decade ago. Things were different then. So even if rates dip, they're likely to stay higher than what we've gotten used to. And that impacts everything. I mean, everything from how much a loan costs to where you decide to invest.
Which is a big deal if you're trying to finance a project. Higher rates eat into your profits. And then there's that wall of maturities. Everyone's worried about all those loans coming due at once. Deloitte doesn't seem overly concerned, though. They suggest alternative funding sources. Things like private credit could fill the gap if traditional lenders get skittish.
Right. It's like finding a new watering hole when the old one dries up, but there are always trade-offs. Private credit can be more flexible than a bank loan, which some investors love, but it often means higher interest rates and tighter terms. Not exactly ideal if you're already carrying a lot of debt.
It's a tough call for sure. And speaking of changing landscapes, Deloitte points out that sustainability in commercial real estate, it's not just a trend anymore. It's becoming a financial necessity.
It's fascinating, isn't it? Investors are realizing that doing good can actually be good for business. And it's not just about checking boxes anymore, it's about measurable impact. Deloitte found that 36% of those surveyed are looking for initiatives with both financial and regulatory benefits. They want to hit that sweet spot.
So you're not just feeling good about where you invest. You're seeing those green choices translate into a healthier bottom line.
Exactly. And that leads to a bigger question. What innovations will we see as this trend gains momentum? What's next?
Speaking of innovation, Deloitte also dives into AI and its potential to, well, kind of revolutionize the industry. Streamlining tasks, finding opportunities in data that humans might miss. It's powerful stuff.
It is powerful, but there's a flip side. Their survey revealed that only 14% feel their data is AI ready. That's a tiny fraction. It's like having a Ferrari but no roads to drive it on.
What a visual.
Yeah.
So all the fancy tech in the world won't help if you haven't laid the groundwork.
Exactly. Data management, privacy policies, a clear strategy, these need to be in place before diving headfirst into AI. Otherwise, you're setting yourself up for some costly mistakes.
That makes sense. Now we've got this big picture view, interest rates, sustainability, AI, but you also brought along some sources that get hyper-local. Norada and Real Wealth's lists of best U.S. cities for real estate investment. Seems they both agree on the key drivers, though.
They're all about the fundamentals: job growth, population growth, affordability, the building blocks of a strong real estate market. But how those play out in each city, that's where things get really interesting.
Let's get specific then. Dallas, for example, Norada highlights its strong job market. People are moving there in droves, the housing market is active, and real estate trends look good. No wonder investors are intrigued.
And if you dig into those trends, it gets even more interesting. The median listing price in Dallas was about $425,000 in March 2024. Now, that stayed pretty stable year over year, which actually points to a healthy market in this climate. Plus, it's a seller's market. Homes are moving fast, which is great news if you're into rental properties. High demand, high potential returns, right?
Right. Now, for someone looking for a different pace, there's Ocala, Florida. Real Wealth really like this one. Affordable prices, a strong rental market, and lots of retirees and young families moving in for the lower cost of living. Different vibe, but still promising.
Ocala is a great example of an emerging market. Job growth might be slower than the national average, but that population growth, it's booming, fueled by people wanting affordability and, I don't know, maybe a bit of a slower pace of life. And the numbers. Well, the median home price there was around $273,449 in January 2024. That's significantly lower than the national average, which is a big draw for investors looking for value and long-term growth.
So you've got Dallas, this bustling city with high demand, and then there's Ocala, more laid back, more affordable. Two totally different paths, but both potentially lucrative for the right investor.
And that's what I love about the U.S. real estate market, right? It caters to different risk appetites, different investment goals. But it's not the only game in town. Deloitte's survey showed that while investors have been sticking closer to home since the pandemic, they're starting to get that international itch again.
Like that urge to travel is back, but for real estate. Interesting to see where they're looking, too. Germany, Canada, Mexico, India, and Australia came out on top as the preferred destinations for cross-border investment. What makes these countries stand out, you think, in 2025?
They each bring something unique to the table. Germany, for instance, with its super solid economy and its massive manufacturing sector, it's always been a safe bet for investors. Canada, on the other hand, has that booming tech scene everyone's watching, and their housing market is remarkably resilient. Then there's Mexico, right on the U.S. border, a growing manufacturing hub in its own right. It's strategically appealing, to say the least.
And then there's India. Their tech sector's on fire, the middle class is exploding. It's like this high-growth, high-potential market that everyone's trying to get a piece of. Oh, and we can't forget about Australia. Stable economy, tons of natural resources, growing population. They've got a lot going for them.
It's clear that investors are thinking beyond their own backyards, looking for diversification, looking for growth. They're realizing that sometimes the best opportunities are in uncharted territory. But before we get too caught up in specific locations, let's switch gears to something ING. Thing highlighted in the bond market, they're predicting an increase in real estate bond supply in 2025. That signals some growing confidence in the sector, wouldn't you say?
Definitely a good sign. More bond activity usually means investors see potential for profit. But here's what's interesting. ING Think found that green bonds are actually outpacing traditional bonds. They reached $10.4 billion in 2024. That's huge.
It is huge, and it shows how investor priorities are shifting. It's not just about financial returns anymore. It's about aligning those investments with your values. Green bonds, specifically designed to finance projects with environmental benefits, they let you do both.
So you're not just making money, you're making a difference, or at least trying to. But it's not all smooth sailing, is it? Deloitte does point out some potential bumps in the road for 2025.
The big one is interest rate uncertainty. Even with the predicted cuts, it's still likely a higher for longer scenario, which makes planning a real headache. And then there's geopolitical instability, think Ukraine, the Middle East, that has a ripple effect on the global economy, which eventually impacts commercial real estate too.
Throw in that wall of maturities we talked about earlier, and yeah, there are definitely challenges ahead.
It's all about being adaptable, staying informed, and being willing to embrace innovation. That's how you navigate uncertainty and find the opportunities.
Speaking of innovation, what about artificial intelligence? Deloitte seems to think it has the potential to completely transform the industry, from automating tasks to making smarter decisions.
It's about working smarter, not harder, right? Imagine analyzing mountains of data to spot trends, anticipate market moves, make better decisions. That's the promise of AI.
Sounds almost too good to be true. But then, only 14% of the people Deloitte surveyed feel their data is AI ready. It's like having a state-of-the-art spaceship, but no trained pilots.
Exactly. You need the right foundation before you can launch. Data infrastructure, clean data, a clear understanding of your goals, these have to come first. Otherwise, AI just becomes another expensive experiment.
Makes sense. So before we move on to part two, where we'll really dive deep into those city-specific insights and global trends, I'm curious, what's one thing, based on all of this, that you think our listeners should be paying close attention to in the coming months? What's got you thinking?
For me, it's the convergence of these big trends that's really got me thinking. You've got interest rates and economic uncertainty, then you've got sustainability becoming this non-negotiable, and on top of that, AI is trying to muscle its way in. It's a lot to process.
It is. It's like the whole industry is trying to figure out what its new normal is going to be.
Exactly. And in the midst of all that, you've got these micro trends popping up in specific cities, offering opportunities if you know where to look. But let's not get ahead of ourselves. We've got plenty to unpack here.
We do. So where should we pick back up? We were talking about alternative capital sources, green bonds, those challenges on the horizon.
Right. And it all ties back to this idea of adaptability. Take alternative capital, for instance. Deloitte's right as traditional lenders become more risk-averse, especially with those interest rates being so unpredictable. Commercial real estate has to find new ways to finance itself.
It's like the industry is learning to walk on two legs instead of one.
That's a great analogy. You've got these Private credit funds, insurance companies, family offices, they're all sniffing around looking for opportunities. They can be more flexible than banks, which can be a lifesaver for certain projects.
But their rates tend to be higher, and the terms a little more demanding.
Exactly. It's a trade-off, like most things in life. But the point is, diversification is key. You don't want to put all your eggs in one basket, especially when that basket is looking a little wobbly.
And diversification goes beyond just where you get your money from, right?
hmm
We were talking earlier about sustainability. It feels like every corner of commercial real estate is being touched by that trend now.
It's not a choice anymore, is it? Investors, tenants, regulators, they're all demanding it. And the
Yeah.
smart companies, they're realizing that sustainability isn't just good for the planet, it's good for business.
Deloitte had some interesting stats on that. Remember how they found that 36% of those surveyed want those win-win initiatives, the ones that are both financially and environmentally sound.
It's not just about feeling good, it's about those tangible benefits, like investing in energy efficient building systems. Yeah, it's good for the planet, but it also lowers operating costs and can even increase a property's value.
And let's not forget the tenants. People are willing to pay a premium for a space that aligns with their values.
Absolutely, especially younger generations. They care about this stuff and they vote with their wallets.
So how can companies make sure they're really integrating sustainability, not just slapping on a green facade?
It's got to be holistic. Deloitte talks about a three-pronged approach. First, you've got to reduce your environmental footprint. Think energy efficiency, water conservation, all of that. Then you've got to think about the social impact. Are you creating spaces that are healthy and inclusive? Are you engaging with the community? And finally, you've got to make sure your governance is in order. Transparency, ethical practices, those matter too.
It's like sustainability has become the new ESG, environmental, social, and governance. It's not just a buzzword anymore, it's a whole framework.
It is. And it's changing how companies operate, how they measure success, how they attract investors. It's a seismic shift.
Speaking of seismic shifts, let's talk about those U.S. cities for a bit. We were comparing Dallas and Ocala, but there's another one that both Norada and Real Wealth highlighted, Spokane, Washington.
Spokane's interesting. It often gets overshadowed by Seattle, but it's got a lot going for it. Solid job market, relatively affordable housing, and that beautiful natural setting people are starting to take notice.
Norada was particularly bullish on their housing market. They said the median listing price was around $380,000 in March 2024. Now, that's a decent jump from the previous year, but still a bargain compared to other West Coast cities.
Exactly. And it's not just about affordability. Spokane's economy is growing at a healthy clip, fueled by healthcare, education, manufacturing. It's a diverse mix.
It's like they've got a little bit of everything going on.
Are they?
That seems to be a recurring theme with these cities, right? They're not just one-trick ponies.
Right. They've got to offer something for everyone. Affordability on its own isn't enough. You need jobs, you need amenities, you need a certain quality of life. It's a package deal.
And speaking of packages, let's talk about the one that's been top of mind for a lot of businesses lately, the talent pool. Deloitte had a lot to say about the challenges of attracting and retaining top talent, especially with millennials and Gen Z entering the workforce with their own set of expectations.
They're shaking things up, that's for sure.
It's like the rule book got tossed out the window, and everyone's trying to figure out the new game.
Exactly. And a lot of it comes down to company culture. Deloitte found that younger generations aren't just looking for a paycheck, they're looking for a purpose.
Huh.
They want to work for companies that align with their values, that offer flexibility, that are invested in their growth.
So what can commercial real estate companies do to make themselves more appealing to this new generation of talent?
Well, for starters, they need to rethink their workplace culture. It's not enough to just offer ping pong tables and free snacks anymore. They need to create environments that are collaborative, inclusive, and flexible.
And maybe offer some remote work options too. I mean, that's almost non-negotiable for a lot of people these days.
Absolutely. Flexibility is key. But it goes beyond that. Deloitte also highlights the importance of mentorship and professional development opportunities. These younger workers, they want to know they have a path for growth, that they're not just going to be stuck in a dead-end job.
It's about investing in your employees, showing them that you're invested in their future.
Exactly, and that's something that a lot of companies in the commercial real estate sector have struggled with. It's traditionally been a very hierarchical industry, not known for its flexibility or its focus on employee well-being.
So it sounds like a pretty big cultural shift is in order. And speaking of shifts, we talked earlier about the rise of green bonds in the bond market. But I'm curious what's driving that trend. Is it purely environmental concern, or is there a financial incentive as well?
It's a bit of both, actually. Yes, investors are becoming more environmentally conscious, but they're also realizing that sustainability can be profitable.
How so?
Well, for starters, there are often regulatory incentives for investing in green projects. Governments around the world are offering tax breaks, subsidies, all sorts of things to encourage sustainable development.
So it's not just about doing the right thing, it's about getting rewarded for it.
Exactly. And on top of that, you've got this growing pool of ESG-focused investors who are specifically looking for opportunities to align their investments with their values. They're willing to pay a premium for green bonds, which drives up demand and potentially returns.
So it's a win-win. You get to feel good about where your money's going, and you might even make a little extra profit along the way.
Exactly. And for the companies issuing those green bonds, well, it gives them access to cheaper capital, which they can use to finance those sustainable projects, making them even more attractive to investors and tenants alike.
It's like this virtuous cycle where everybody benefits.
Yeah,
I love when that happens.
me too. But let's not get ahead of ourselves. It's still early days, and there are always challenges to overcome. Challenges are inevitable, but that's how we learn and adapt.
Right. Exactly. Speaking of adapting, we were talking about those evolving tenant preferences and how they're changing the very definition of a prime location. Deloitte made a point of saying that while location still holds true, what makes a location desirable is definitely shifting.
It's a fascinating dynamic. We're seeing a move away from that traditional central business district model. It's not just about being in the heart of the city anymore.
Yeah, it's not just about the address, it's about the whole experience.
Right. It's about finding that sweet spot where you've got accessibility, affordability, and a vibrant mix of amenities.
It's about creating a destination, not just an office building.
Exactly. Think about it. Tenants today, they want access to public transportation, they want walkability, they want to be near restaurants, shops, parks, they want their work environment to blend seamlessly with their lives.
It's that whole work-life integration thing we hear so much about.
Exactly. And technology plays a huge role in that too. Reliable internet, access to co-working spaces, flexible work environments. These are all non-negotiables for a lot of tenants now.
So it's not just about the physical space anymore, it's about creating an ecosystem.
Precisely. And that brings us to another interesting point, how the workplace itself is changing. Deloitte talks about the traditional office-centric model being challenged, with remote work becoming more common, and those younger generations having different expectations.
It's like the office as we know it is having an existential crisis.
In a way, it is. Remember, Deloitte found that 51% believe the hybrid model is here to stay. That blend of remote and in-office work is changing how we design and use office spaces.
It's not about rows of desks anymore, that's for sure.
Right. It's about creating spaces that foster collaboration, creativity, innovation, dot spaces where people actually want to be, not just have to be.
So it's less about cubicles and more about creating an experience.
Exactly. And that's where co-working spaces come in. Deloitte found they're becoming more and more popular, offering an alternative to traditional office leases.
It makes sense they're flexible, they're relatively affordable, and they often come with a built-in community.
Exactly. And that social aspect is important, especially in a world where people are working remotely more often.
So what's the takeaway for commercial real estate companies? Do they need to become co-working experts?
They need to be aware of the trend, for sure. Some companies might incorporate co-working spaces into their portfolios, either through partnerships or by developing their own concepts. Others might focus on making their traditional office spaces more flexible and amenity-rich to compete. It's about adapting to what tenants want.
And what about data? It feels like data is everywhere these days.
It is. And Deloitte makes it clear that in commercial real estate, data is no longer just a byproduct of transactions, it's a strategic asset.
It's about using information to your advantage.
Exactly. Deloitte found that a majority of those surveyed are investing more in data analytics, mainly to automate processes and make faster, more informed decisions.
So less gut feeling, more data crunching.
Right. And it's touching everything: market analysis, site selection, tenant profiling, you name it.
It's like having a crystal ball, but instead of magic, it's data.
I like that. And one of the most exciting applications of this is predictive analytics, using historical data to anticipate future trends and make proactive decisions. That's powerful stuff.
So instead of reacting to problems, you're preventing them.
Exactly. And that can save you time, money, and a whole lot of headaches.
So data analytics, definitely something for commercial real estate companies to keep on their radar.
Absolutely. Now let's talk about something a little more tangible, smart buildings.
Ah, yes. The buildings of the future that are already here.
Exactly. And they're not just a gimmick. Deloitte highlights how these buildings offer increased efficiency, lower operating costs, better tenant comfort, and even improved sustainability.
It's like they checked all the boxes.
Yeah.
But how do they actually work? What makes them so smart?
It's all about technology integration. Smart buildings use sensors, data analytics, and automation to monitor and control everything from lighting and temperature to security and access.
It's like the building has a brain of its own.
In a way, it does. And that brain is constantly learning, optimizing performance, and making sure everything runs smoothly.
So, for example, if the sensors in a smart building detect that a certain area is empty, the lights automatically turn off.
Exactly. Saves energy, saves money, everyone wins.
Smart. So what's the holdup? Why isn't every building a smart building?
Well, it's a significant investment upfront, but the long-term benefits in terms of cost savings and increased asset value are hard to ignore.
It's short-term pain for long-term gain.
Exactly. And as the technology becomes more affordable and more sophisticated, I think we'll see even faster adoption in the coming years.
So lots of change on the horizon for the commercial real estate industry. What's the one big takeaway you'd want our listeners to leave with today?
I think it's about embracing adaptability. The world is changing faster than ever, and the commercial real estate industry needs to change with it. Whether it's embracing new technologies, adapting to evolving tenant preferences, or finding innovative ways to finance projects, those who are willing to evolve will be the ones who thrive in the years to come.
I love that. Embrace adaptability. That's a great note to end on. Thank you so much for joining us today and sharing your insights. It's been a fascinating conversation.
It has. Always a pleasure to be here.
And to our listeners, thank you for tuning in. Be sure to check back for our next deep dive, where we'll tackle a whole new set of trends shaping the future. Until then, keep learning, keep growing, and keep building.